When we think of a bank, we probably picture a solid, stable fortress, right? But the reality is, it's more like a high wire act. Every single day, banks are walking this incredibly delicate tightrope. And if they lose their balance, well, the consequences can be massive for all of us. This is it. This is the single biggest fear for any bank. It's the ultimate stress test. Because here's the thing. While your money is safe, it's not all just sitting in a big vault with your name on it. So what really goes down when confidence shatters and everyone makes a run for the exit? And believe me, this isn't just a textbook theory. Let's look at a real-world case that shows just how scary fast a bank's cash can completely dry up, almost overnight. Okay, look at how quickly this all happened for Northern Rock. In the middle of 2007, things are fine. But then, whispers from the U.S. housing crisis make other banks super nervous about lending to them. The moment the news hits that Northern Rock needs a bailout from the Bank of England, it's game over. People panic. You literally have lines of people snaking around the block trying to pull their money out. A 21st century bank run right there on the evening news. And just a few months later, the government has to step in and take over the entire bank just to stop the whole system from imploding. So that's what a liquidity crisis looks like in the wild. But what is it about banking that makes this even possible? It all boils down to this fundamental mismatch right at the very core of how a bank works. And this slide lays it out perfectly. On one side, you've got what the bank owes, its liabilities. That's mainly our deposits, right? Money we can ask for back, like right now. That's all short term. But look at the other side. That's what the bank owns, its assets. We're talking 30-year mortgages, 5-year car loans, all long-term stuff. See the problem? The bank has promised to give us our money back on demand, but its own money is tied up for years, even decades. That's the tightrope. So this basic mismatch, it doesn't just sit there quietly. It actually creates all these hidden risks, these powerful forces that can pop up out of nowhere and throw the whole system off balance. And one of the biggest risks is something that nobody, not you, not me, not even the bank itself, can control: interest rates. When interest rates move, it doesn't just tweak your loan payments, it fundamentally changes the value of everything the bank owns and owes. All right, let's make this super simple. Let's say a bank has 100 crores in assets, all those long-term loans, and it owes 90 crores in liabilities. That's our deposits. The difference, that 10 crores, is its net worth. That's its safety cushion. Everything looks great, right? But then, something happens. The central bank raises interest rates by just 1%. And you might think, 1%? What's the big deal? Well, to a bank's balance sheet, it is a huge deal. Boom, just like that, the bank's 10 crore safety cushion shrinks to less than 8 crores. Now, why did that happen? Because when rates go up, the value of all those old long-term loans drops. A tiny 1% change in rates just wiped out over 20% of the bank's entire net worth. Imagine if rates went up by 3 or 4%. And this brings us to the heart of the matter, to this thing called liquidity risk. It's not about whether the bank is profitable over 30 years. No, it's about this. Does the bank have enough cold, hard cash right now, today, to pay its bills without having to sell its best assets for pennies on the dollar? Now, the trouble can come from the asset side. Maybe a big economic downturn hits and suddenly lots of people can't pay back their loans. The cash the bank was counting on just isn't showing up. Or maybe some bonds it owns get downgraded and suddenly nobody wants to buy them. The stuff that looked solid on paper suddenly can't be turned into cash. Or the pressure can come from the other direction, the liability side. This is exactly what happened to Northern Rock. A bit of bad news, a rumor, and you get a full-blown panic. Everyone wants their deposits back at the same time, demanding cash that the bank just doesn't have lying around. So you see, the danger is coming from both sides of that balance sheet. So you might be wondering, if banking is this fragile, why aren't banks just collapsing left and right? Well, because of disasters like Northern Rock, regulators have stepped in and built some pretty serious safety nets designed to handle exactly these kinds of risks. Yeah, you can think of it like a defense system with multiple layers. We're going to focus on a couple of the really key ones that basically force banks to have different kinds of emergency funds ready to go when things get rough. So let's start with a big one, the statutory liquidity ratio, or SLR. This is a pretty straightforward rule. It basically tells a bank, hey, you can't lend out every single rupee that comes in the door. A certain chunk of that money has to be kept in things that are super safe and can be sold for cash in a heartbeat. We're talking things like gold or government bonds. And to put a number on it, in India right now, that's 18%. So for every 100 rupees you put in the bank, the law says they have to set aside 18 of them in these ultra-safe liquid assets. That's a pretty significant buffer. Okay, now for the modern upgrade. This one is called the Liquidity Coverage Ratio, and it came about directly because of the 2008 crisis. You can think of it like a mandatory 30-day fire drill for the bank. Regulators essentially say, imagine a crisis as bad as 2008 starts tomorrow. Show us you can survive for a full month on your own. The LCR forces them to prove it. And the requirement isn't that they cover most of the potential losses. Nope, it's 100%. The bank has to hold enough top-tier liquid assets to cover every single rupee they'd expect to lose during a 30-day panic. This rule is specifically designed to stop another Northern Rock from happening. It buys everyone a month to figure things out. Look, I know this can all sound super technical, something for economists and bankers to worry about. But the stability of this whole system, this constant tightrope act, is absolutely fundamental to, everything in our economy. So I think the biggest thing to take away from all this is that this isn't a problem you can just solve and walk away from. It's a living, breathing, dynamic process. Managing that gap between short-term promises and long-term realities, that is the forever challenge of banking. When they get it right, economies grow, and we all benefit. When they get it wrong, we all feel the pain. And that leaves us with one final thought. All these new rules we have, like the LCR, they were designed to fight the last war, the crisis of 2008. And yeah, the safety nets are stronger now than they've ever been. But finance never stands still. So the real question isn't whether we're safe from another Northern Rock. The real question is, what's the next hidden risk? The one we haven't even thought of yet, that's waiting just around the corner. What's the next tightrope we don't even see?